This is Nate Dodson, and you're tuning into And This Is Why, the podcast show. A show where we help you take your business to the next level. New episodes every week streaming on your favorite streaming platforms. Enjoy today's episodes. You need to learn how to make money off real estate debt. And this is why. Today we're talking to Rob Napolitano, where we're going to dive deep into things thinking about entrepreneurship, making money off good debt, bad debt, ways you can even profit out of bankruptcy. And you know what? We're talking to really a master that's been in the industry for decades. Real estate mortgages, and how to work them out when things go a little bit more difficult, but for your benefit. So let's learn a little bit more from Rob Napolitano, and this is why.
When you're doing business, you have to have a meeting of the minds. It's always about people first. Always about people. Business is about people and character. So if we can have a meeting of the minds about how your skill sets, what you bring to the table can complement what I can bring to the table, and together we're stronger. And as long as, we're still you're traveling in your lane, I'm traveling in my lane, but we're traveling together and we're moving forward for a bigger purpose, we're great. But stay in your lane, stay in my lane, and you can define all that stuff. But as soon as you get away from that mental commitment, it won't work, right? And so you go to contract and use attorneys, in my opinion, to codify what the two humans already agreed upon. What are the business terms, what it's going to look like, put it on paper for a number of reasons. God forbid something happens to one of us, and whether you have succession planning in place or not, there's always going to be some third party that says, so what was this relationship like? Let's go look at the contract. Let's go look at the papers. This is what's supposed to happen. This is how we'll carry it out. Great. But also, if it gets into the form of a dispute, you can always go back to, what do the agreements say? And it goes back to consequences. If things don't work out, how do you kind of unwind and agree to, and litigation and consequences and all this stuff and everything? So you can make your business decisions, but then when you get to the contracts and the agreements, you're really working out what are the consequences going to be if it doesn't work out. Because if things work out as it's supposed to, they rarely do, then you don't need the contracts and stuff anymore because you're already there and you're already working in each other's favor.
I wanted to kind of explain my process of what I do with everybody, our clients and everybody else, and how to get into those deals, because I love what you're talking about with, you have to have your roles, your responsibilities, your understandings, and eventually it all needs to come together in a contract, but it's kind of a process.
Yeah, definitely.
I call it the dance.
Yeah.
Like you're just getting to know one another. You're getting deeper and deeper of understandings of what you can do, your abilities, your strategies, and whatnot. And so I wanted to share with you and kind of just my process of doing a deal.
Yeah, absolutely.
And I've got one of these going on right now, kind of interesting. I've got a med spa that doing a deal with. And started out the exact same way I'm do every project. I send out an email, just bullet point terms, real high level.
Yeah.
This is what I'm hoping to accomplish with you.
Yeah.
If you agree, let's talk more about it.
Make it more exploratory.
Exactly. But not scaring people with, here's a contract.
Yeah.
Here's my attorney.
Yeah.
Like that just freaks people out and you run.
Yeah.
But just a simple bullet point of, here's what I'm hoping to accomplish. Here's where I see your role. Here's where I see where we're agreeing. Do you want to talk about it more?
Yeah.
After having that discussion, there's always further collaboration, more ideas come into to play. And then the next step being a letter of intent.
Yeah.
Non-binding letter of intent, but now instead of just a couple of bullet points, we're doing a 2 to 5 page just letter, non-binding, meaning that if anybody wants to walk, they can walk.
Mm-hmm.
But let's start getting a little bit deeper.
Yeah.
And unlike most attorneys, the way I see it is, if we're agreeing on that letter of intent, before we really get into the formalization of an agreement, let's start doing our due diligence on one another.
Mm-hmm.
On the acquisition, on the project, on whatever we're trying to accomplish. to save the cost of the attorneys, to save the headache of negotiating the nitty gritty, let's, have this LOI that may have certain sections that are binding, like non-circumvention. You can't go around me. We're working on this deal together. Mm-hmm. Confidentiality. I'm going to share with you information that I really don't want you to share with anybody else. And timelines.
Yeah.
Like, what are we really expecting together? But short of that, like, are we agreeing now from bullet points in an email to 2 to 5 pages of a non-binding, except for these sections, LOI? Then let's do our due diligence.
Yeah.
Let's look at whatever background, whatever note acquisitions. Let's get into the data room and now decide, does it make sense to continue to partner, to continue the acquisition, or whatever the deal is? And not until that point, let's bring in these attorneys.
Yeah.
Let the attorneys work it out. But now all of a sudden we're dealing with it's like a marriage. It's high level, everything makes sense. You get into the minutia and you start to realize you don't necessarily see eye to eye.
Right.
And I'd rather us both understand what's going on as we're going down the path to this nuptial of an agreement.
Yes.
And then get into the nitty gritty.
Yeah, I think that's the perfect way of doing it. So from my perspective in doing these, I've been doing real estate for 20 something years now. And a couple of things that I wanted to say. The one thing that I was taught, especially in closing a deal, is whatever you agree upon when you shake hands with that person, because it always starts with a conversation, shake hands, let's go ahead and do it. And like you said, it's always going to expand into more detail. But whatever you talk about, when the papers finally come between the two, the papers better iterate with a meeting of the minds, because that's exactly what happened to me just the other day. We had a meeting of the minds, and when the attorneys got into all the business terms were changed, I didn't even look at what the changes were. I said, sorry, not for me. Because if we're not going to be on the same page going in, now if you wanted to make changes, there are things you're uncomfortable with, then there better be some communication to say, hey, I'm not comfortable with this. Let's shave this here. Let's carve this. Let's work together. I don't want to see it when the paper gets pushed back to me, all these terms are changed. I didn't even look at the terms. I was like, not for me.
Well, I can tell you that happens more often than you can imagine.
Absolutely.
But it's also pretty often it's the attorney's fault.
Mm-hmm.
You and the principals may have a meeting of the mind, but then, attorneys, we're people. We're
absolutely
fallible.
No doubt.
Get in there and we don't really understand it. That's where my process comes in to perfect it before the attorneys can come in to screw it up.
I want to give you some perspective on that as well, being the non-attorney. So my perspective, just a little bit of background. So I went to law school to become a paralegal. I didn't get my real estate license, don't have my banking license anymore, didn't want to get a law license, because in my opinion, you only need a license when you're going to represent somebody else's interests, and you need to be that fiduciary. I put my own money in every deal. I'm involved in every transaction, every banking deal that I do, and it's my own money, my own personal interest, along with other investors that want to come along for the ride as well. So in that sense, I don't need to have a license because I'm representing my own interests and those that are aligned with me. So I went to law school not to become an attorney, but I wanted to learn how the system worked, how the legalese worked, and how the game sort of gets played, and I wanted to understand how to operate in there. And one thing that I found a number of things, but I'll tell you just two things that I really have over time that I've come to my judgment with attorneys. And here's my perspective of attorneys. So I'll start with part one here, which led me to the next part. So when I was I went to law school, I started a litigation support company helping attorneys who were doing foreclosure defense. I was an expert. We were doing mortgage audits. I knew all the banking side, gave them a whole bunch of issues that they may turn into legal defenses and all that stuff. And we did something like, 4,000 or 5,000 cases we did back, during the Great Recession. So a couple of things I found out is trying to put a program together where attorneys can go and do this. It's easier to herd cats than getting a whole bunch of attorneys together because everybody's got different ways to do it. So that was a failure there. But what I found was 3 types of personalities with attorneys, okay? I found the one attorney who, personality type, the attorney avatar, if you want to call it, who would be, how can a non-Ivy League person be smarter than me and come up with this stuff unless you have a pedigree, with 14 different accredited Ivy League schools and connections at the highest level of the courts. I don't even want to talk to you. So that was one. So that was an ego, right? Can't tap into the ego, can't work with those people. Then you get the next person who would be, coming up with these sort of defenses and strategies and stuff, and you'd get that attorney going, doing that. And I knew that attorney was just a blubbering idiot, had no idea what you were talking about, but didn't want to look stupid. Because this stuff is not easy. It took me years and years and years to develop. So if you're over there saying, I get you right away, no, you don't, because this is way high level, and you got to learn this in layers and layers and layers and layers. So if you think you get, no. So you're just an idiot. I can't. And I've seen some of those. And then you get the third attorney who'd be like, I have no idea what you're talking about, but it sounds like we can do something together. Show me what you need me to do, and let's go do this together. And that's the person that I would work with. You don't know, I don't know, but together we'll figure something out. And we had a tremendous amount of success with attorneys like that. And so what I've come to learn over time is this. Attorneys in the world of, especially real estate or any type of transaction, I look at it as playing football, let's say, right? American football.
Gridiron
football. Or any kind of professional sports where we have two adversaries and a third-party neutral referee. Okay? The attorneys are the referees. They're on the field, they're in the game, they know the rule books. And they'll be there to throw flags at you every time you do something wrong. But to rely on the attorney to say, hey, should we do this play? Or should we do that play? Do you think you see weakness over there? The referee's not going to tell you that. The referee is going to say, and the attorney is going to say, you're out of bounds over there. You're not allowed to hold. You're not allowed to hit below the knees. So, as investors, we're the players on the field. That's why we get to score all the points, make all the money, get all the accolades, and the attorneys sit there and watch, and will throw flags at you. That's what attorneys will do. So you should never ask your attorney for the advice how to put a deal together. Now, let me finish one last thing.
You got the wrong attorney.
One last thing now. Now, attorneys that have business sense as well, I don't consider attorneys. For instance, I put you in this category. I consider you to be a business entrepreneur with a law degree. Different. Your primary way of thinking and mode of thinking is putting deals together as a business person. Just so happens you have to have a law degree and know the law and how a lot of this stuff works. But when you wake up in the morning, you're thinking as an entrepreneur, not as an attorney. Because most attorneys are trained to stay away from risk and cut out this risk and cut out that risk. And without risk, you can't make any money. Okay? But entrepreneurs are designed to accept risk, mitigate risk, take on risk, overcome risk. So I don't consider you an attorney. I consider you an entrepreneur with a law degree. So I put attorneys as the referees. They'll just throw flags at you. But then they call themselves attorney because you get the benefits of putting an ESQ at the end of your name, but you're not really an attorney. You're a businessman. You're an entrepreneur with a law degree, which is a different category. That's the way I see it.
Let me give you the counter argument to that. And actually, I agree with you. I think more like an entrepreneur than an attorney. That doesn't change the fact that actually I've got 16 attorneys and they're all trained to think like this. But it isn't, I see it as there's only two types of attorneys. You got the deal making attorneys and the deal breaking attorneys. The deal breaking attorney says, well, you've got these risks. You've got these problems. You should just walk away.
Yeah.
And I actually understand that from the attorney's perspective because there's no upside to them to take the risk to coach somebody properly with, here's really what your risk is. Here's the ways to mitigate it. Here's some strategies around it where you can still get the deal done. And maybe there's more risk than zero, But it always comes down to don't put all of your eggs in one basket. There is always risk in doing deals in entrepreneurship, and those are the people that we work with.
Yeah.
But that's also where all my attorneys are trained to, we're your guides.
Yeah.
We're here to be the head of that cheerleading squad of like, here's our next step. Here's how we're going to get across the end.
Yeah.
And that is absolutely where we take a different approach than most attorneys that are out there.
And that's why you stand out from the crowd, because, again, I'm going to keep it in mind. You guys aren't attorneys. You guys are deal makers, as you say. You're business guys and women who have law degrees and know how to get deals done. But you are the exception to the attorney classification, and that's why I kind of just carve it out as something separate. I think it needs to be distinguished as something separate. So, because most people look at attorneys as, the people that are just either killing deals or just acting in the law. But no, you guys are in the business side of it. So you're kind of, the gizmo from all the other gremlins, the good one out of the bad pack of.
I appreciate it. It is always about the zealous representation, explaining the risks, diving in deep, and being creative of the, there's more risk doing it, going down path A. Let's look at path B, C, D, because there's a bunch of ways to accomplish goals.
Absolutely. So, and I have experience with both, right? Just last week, I had one attorney who's doing a deal for me in Indiana, and we're foreclosing. And it's a commercial deal. It's a fix and flip that haven't been paid, and it was a seller finance deal that we purchased. Now, the note wasn't written up in the best terms, and we actually acquired it with a pool of other loans that we got. So sometimes you pick up some of this crap. This was a crappy deal. That was a crappy deal. It was a good deal, but it certainly wasn't written clearly. And so the issue was we were charging default interest. But the note didn't say what default interest was. The note said it was a 10% interest, and in the case of default, it's 10% interest or whatever the highest interest rate is allowable under Indiana law, whichever is higher. So it's not an explicit number. You got to go do a lookup, okay? Our team looked it up and it was like 21%. So we were charging default interest at 21%. Pushed it to foreclosure, and the foreclosing attorneys came back. How'd you get to 21%? This should be 10%. Like, no, we don't see where it says 21%. Right? It doesn't say it on there. And we got to this pissing match, and this is a new law firm that picked us up. And so they got into a pissing match in the emails with everybody on board. I said, really? This is how you want to do this? No problem. I can communicate that way on the big stage, on the big soapbox, seeing who's the bigger ego here. And I went right back. I said, it's 21% if you read that part of the note. And he came back and says, well, what law says that you can do that? So I went back and right back. I said, why don't you find me what law says that I can't, and we'll start from there. And so he took it off the email and made a phone call to me. I was like, that's better. So instead of showing off in front of everybody, how about we have a conversation? And he go, well, where did you get that from? I said, my team just looked it up on Google. Google? I've been doing this for 50 years. Who uses Google? I said, if you've been doing law in Indiana for 50 years and you don't know what a default interest rate is in the state of Indiana for 50 years, I said, we have a problem here. Like, why are we having this conversation? And eventually he acquiesced and got some paralegals to look it up, and we were right. Versus litigation that I have going on in Maine, and we could talk about that case. It's such an interesting case. And my attorney, I was on the phone with for an hour, and we talked about strategy, and we came up with 5 different ways for us to make some money. Now, this is litigation been going on. I picked up that loan back in 2015, I want to say. So you're talking 8 years I've had this loan. And we went through 2 federal cases, 2 federal litigations, and we're going through our 3rd round of litigation.
Glad you went to law school.
And actually, this is probably a good case to talk about because there's some business logic here, and then there's some legal and litigation logic here. And we're getting to a point where where we're crossing that Rubicon where I totally turned. I said, you know what? Let's just do a deed in lieu and give the property. And she's like, no, we can do this, we can do that. I was like, I know, but now we're getting to a point where we're getting litigation fatigue. We were willing to put money into round one, round two. And honestly, I told her, so her partner had taken us for the first couple of years. Now he subsequently retired. And now she, as the other partner, picked us up. And I honestly like her better. Wish we had her from the beginning because she's much more entrepreneurial and thinking through strategies. And her family comes from real estate investing. And so she knows how to kind of strategize. And we're talking more strategy. I said, honestly, your partner taking us through round one and round two, and we're spending all that money. Now we're getting to a point where it doesn't make any more economic sense. And as a strategy, now we have that property's been sitting for so long that the city is now coming and putting violations on the property. I said, just give it back to them. I don't want to see you give up. We could put a receivership in place. We could take a super priority lien over. We can do all this stuff. And I said, great. But now property management's making money. You're making money. And this bank is also going to accrue. And it all encumbers all the equity that's there. That's my money. And my money keeps shrinking while I'm supporting everybody else's business. Yeah, I guess you're right. So we can't, but we talked through different ways to the point where she suggested, I have an adversary in another case right up there as well. Really smart guy. He's an adversary, but we actually become a little friendly. He actually may be able to help you. So let me put him in touch with you and see what you guys can do from the business side to see if we can go and take this legal strategy. And so that's the difference where she wants to talk about strategy, how to make money for her clients. And we went through legal strategies and business strategies and all the different ways these things can work out. And I liked her strategies, but in the end I said to her, yeah, we could do that, we could do this, we could do that. But there's so many variables still there that we still may end up back in federal court again against that other attorney that beat you guys twice. And I'm not willing to put you up to bat against them for a third time. She goes, it could go that way. And I said, and that's what's stopping me. That you guys struck out the first time against them, the second time against them, and I'm not willing to let you go up a third time. And if we push this, that adversary is going to say, you know what, let's just hire this law firm again. And so I don't want to be in that position a year from now to say, hey, when we had that conversation a year ago, probably should have just cut bait then.
Let me give you the counter argument of how wonderful this attorney is, because let's not forget the practice of law is a business in and of itself. Mm-hmm. And her action of being creative, giving alternatives, potentially bringing in a whole nother money source.
Yeah.
It's to continue a case with her firm that has been going on for years. Yep. You're just another source of income.
Yep.
And I'll say kind of with what we do, everything we do is kind of fixed fee to the extent that we can. You know what you get into because I know exactly what you've had to go through of step one. This is going to be easy. Yep. It's not going to cost a lot and then just on and deeper and deeper. And that's unfortunately a big issue within the legal community that we've at least kind of done away with through our fixed fee models.
I agree with you. It's there 100%. But this was a little different because I'll give you the business side of this. Because knowing exactly that, they want to pull you in and do that, going back to risk and consequences. Okay? We play this from the perspective of consequences. And I know that's the way she was pulling. Yes, we can do this. We can definitely do this. But we were going for, our case was a case of first impression, as they call it. We were looking to set a precedent. I knew that when you go set a precedent, especially something like this, it's going to cost money. And so our analysis was that if we can get this precedent set, that the field of opportunity in that state that we had access to would pay off in multiples if we can just set that precedent. And that's what the bet was. Knowing that if we can get over that hurdle, what was on the other side of that would have absolutely been worthwhile. The challenge is, do we have the right legal team to go up and push forth? We had 2 cases that went up to the Supreme Court that were going to fall in our favor. Okay? And we were going to be the case of first impression based on both of those cases. But it turns out, again, one of these large institutional lenders had some very crafty attorneys and took the issues out of the way, go into the weeds, and got things dismissed based on things that were not the core. And so that comes out to litigators and selling the argument and selling it on to the judge. So we came back out, brought the case back in. Turns out we ended up on the same judge's docket. And so, luck of the draw, we lost that one too.
I can say that that's a risky proposition of precedent setting, meaning you're trying to go against the grain to create a new right, to basically create a new law. In the U.S., we follow common law, which is basically the laws based on what's been decided in the past by the courts. And courts don't like to change direction.
So we were actually going in the court's direction. So here's what the precedent was. The issue was, and this all stems from the Great Recession when banks used, how far back do I want to go with this? When we got into the mortgage-backed securities world and Wall Street got involved with all these mortgages, they were doing so many loans and packaging all these loans that under the auspice of efficiency, they said, well, we can pass these loans back and forth electronically, and electronic copies can work as we trade these things. Fine. That worked fine in the trading business. When they sold them as mortgage-backed securities all around the world, packaged them up, moving them digitally, worked perfectly. The challenge becomes that when you want to go foreclose, you have to have an original wet ink copy. And so what had happened when the subprime crisis hit and all these foreclosures had to spike, I've heard cases of where when these banks even digitized these documents, they shredded and burnt originals. And now to go into court with copies of these original notes does not hold up in certain jurisdictions. That's akin to going into your coffee shop and paying for your coffee with a Xerox copy, for those of you showing the age of what a Xerox copy is, of a $10 bill. I can't pay for my coffee with a Xerox copy of a $10 bill. I need the original $10 bill. I can't pay my legal fee by faxing you a copy of a check. You need to have the original. And that's what this was akin to, that if you come in with a copy of a note to say that I can foreclose, because there have been cases where someone gone in with a copy of a note to take back the house, whereby later on, someone with the original note would show up looking to foreclose on the same property, only to find that it was gone to another lender because that loan had been traded into 2 different securities simultaneously. That's why you need to have the original note and be the bearer and the holder of that note. Now, Maine was pushing forward saying, okay, here's what we're going to do. You need to have the original note, and in order to create this judicial efficiency, you're going to get one bite at the apple. If you come in here with a copy of a note and you get knocked out because you don't have your ducks in a row, and I'm summarizing, then you will get another bite at the apple to foreclose on that property in this state with regard to that note. You're like, okay, that sounds great. Now, I came in, I bought a bunch of seconds. And going back to the specific case, I bought a second, had the original note, and it turns out that the first tried to foreclose, but got dismissed because they didn't have the original note. And now they were trying to pass these laws saying, well, you got your bite at the apple, and so now you can go for, and I forget what they call it, you can go for some sort of motion to basically quiet title as to their foreclosure action. Now, my suggestion from my attorney was, you're not going to get them to quiet title. Okay, they're never going to wipe out the mortgage. But what we should do is leapfrog them as far as priority, since I have a better perfected lien interest and I perfected quicker than they could, that I should take priority and then I can foreclose them out. And I think that'd be easier for the legal community to digest. Whereas they were going for, no, so if you can't foreclose because you already had your bite at the apple, then you just get wiped out. I wasn't necessarily a fan of that, but that's where the law was going. And we were the case of first impression because I was able to foreclose because I had a physical note, and we had a foreclose subject to the first, who has not shown up yet with their original note. And so that's why we were going up after these Supreme Court cases had come out, that you only get one bite of the apple. We were going to, and I forget what the action was. It was, we were going for a specific action to quiet title, but it wasn't, I forget, it was something specifically called. I forget what the legal term of it was. And that we were going to be one of the first ones to go up to the court to say, well, now that they've had their first bite of the apple and you've laid out this groundwork, they come back anymore, and we can kind of wipe them out through this process or order. We want to be the first ones to get it. And so that's where the other side came in. And they said, no, not that, it's this. And it started taking all sorts of different directions. And so that's where the battle comes in.
And actually, as you describe it, it sure makes sense.
Yeah.
Because it's not perfecting. Perfecting is the recording, first lien recorded first. However, if they don't have a good claim without the wet ink, they become an unsecured creditor.
Which is what I said.
Yeah.
I was going to that as exactly. I'm like, it's not that they're out the money. They just have to go back to the original homeowner, who, by the way, had vacated the property. That property is sitting vacant now for like 8 years, which is why
Good luck.
The city now is coming and putting violations on there because it's becoming dilapidated. But we don't want to put any more money into it because we're, subordinate to, we're deed holders now. So now we're equity owners because we own the property, subject to the first, who doesn't have a note and is not responsive.
But kind of an interesting argument, and I'm sure it came up, so I want to hear what the response is, because even if you were able to foreclose on the second,
I was the second.
Assuming you foreclosed on the second, did the first, which was recorded at the county recorder level, still get paid off in full before yours got?
No, we foreclosed subject to the first.
Right. And that's subject to the first, so they got paid off.
No,
they didn't.
No.
So they got kicked out.
No, I just took the property subject to the first, which means there's still a lien on title.
Good luck collecting.
Well, right, exactly. And that's where we're at this standstill. We're at this standstill now where, they're not being responsive. We tried going, I'm still trying to think in the back of my head as we have this conversation, what that action was called. We were going for it'll come to me. I got to dust the cobwebs off that part of the brain, but it'll come to me. We were going for this motion to quiet title, and they weren't coming forward. They were being unresponsive. They didn't want to cut a deal. So we said, fine, then let's just sit and wait, and we'll do it from a defensive posture when they want to foreclose. And so they started foreclosure a year ago. This is our third swipe at them. And so we're very careful in how we're answering and how we want to get discovery and how we want to put forth their foreclosure. Now, what's interesting is that they are noticing the original borrowers that haven't lived in that property in 10 years and not really noticing us as the owner, not acknowledging that I have a foreclosure judgment and have a sheriff's deed, that we're currently the owner and not noticing us. So the law firm on the other side again is kind of being a little sloppy about it, which is what's making me a little nervous that if we get too aggressive with this, then let's call back the other guy that kicked our ass twice. Let's give it to him. So let's kind of be a little, so it's a delicate process here and how this works.
It sounds like it's supporting your position of they had their bite of the apple, the security is gone, now their claim is against the homeowners,
Right.
which haven't been there for 10 years. It sure makes sense to start quieting title.
And so, my doubt is with the law firms that we have. Maybe they're not doing it the right. I said my personal strategy would have been, let's just leapfrog, because then instead of wiping them out through this new setting a precedent, let's at least take priority over them. Then we can go do a regular foreclosure, and everybody understands how that works, right? So if I can just leapfrog them, that would have been a lot easier, I thought.
I think you bring up something that's unbelievably important, is history, what's worked in the past.
Yep.
And we're talking about this from a legal setting, but to hop back to entrepreneurship, there's not a lot of precedent setting types of businesses out there. It's you have a model that works. You have processes that work. Let's apply it in different ways. Let's figure out different strategies. But at the end of the day, let's go back to what is tried and true, and everybody's comfortable with that. So I love your plan and idea of let's get in a position that we just have to do what everybody knows
what to do. That's it.
and expects.
Yeah.
I mean, changing precedent is the killer.
Yeah.
That I see that as like that, oh, we're going to disrupt the industry. Everybody says disrupt the industry, but the reality is it's very few that are able to do that.
And I wasn't looking to disrupt the industry. I was looking to go back, dig out the law books. The law is there about perfecting lien interest and what's really going on here equitably, right? Because now we have what's going on. We have a city inspector that hates us because they think we're just neglecting the property, but we're in a position that any more money we put in, we could lose. And I'm being a good fiduciary for my investors to throw the money in after that when I know it's going to be money lost. So I'm unfortunately pissing off the inspector when we're actually on the same page. We both want that property cleaned up and to be put into good use for a good family in a good neighborhood. We both want the same thing, except our positions are not aligned together because of what the big institutional bank is just has these processes in place, people in place, no one that really knows what's going on, and we have to go through this judicial process, and all they do is get an attorney to say, push back, and no one's looking at the underlying thing that I'm the one that can actually solve this problem, but everybody's working against me. The other bank is working against me. The city inspector is working against me. We have to wait to get onto the docket, and it turns out that the docket is backed up for another couple of years, so that's why at this point I'm saying I'm trying to do what I'm trying to do, but it might just be easier at this point. Do a deed in lieu. Let it be their problem, and let's go fight this fight elsewhere. Now, what I didn't tell you, okay, because people are listening to this, because this guy's nuts. My basis for this loan is so low that spending this money, a couple of things how we analyze it. See, there's actually 7 ways to make money in real estate. And one of the ways is capturing appreciation. So we had such a low basis on this. Appreciation, I mean, this property, when we picked it up, is worth $180. It's worth over $500,000 now in that neighborhood. Okay? So while I'm spending money and upping my basis, there's still such a spread on this thing that if it came to fruition, even after 8 years, you're still making a good return. The challenge is, I just go back to the football analogy. The challenge is we're on the goal line, trying to get into the goal line, but we can't penetrate the defensive line to get in. Now it's 4th and goal. Do we want to take the 3-pointer and walk away what we got? Or do you want to go for 4th down and try and punch it in one more time? We were 1st and goal on the goal line and couldn't make it for those down. Do we want to go again on 4th and goal or take the 3 points? And that's where I'm at, because the team has not punched it through. They all say, let's go for it, let's go for it, let's go for it. And I'm like, I got litigation fatigue. I've seen the plays the other side. All these forces working against us. Yeah, we could, but is it really the right decision? And so now I'm at the point where I'm at the deed in lieu, unless one of these other strategies that we talk about is going to convince me to yes, and no longer convincing me, yes, let's go forward just yet.
I love the risk analysis of what really makes sense financially. I think something that people don't really understand all that well is you can make money with losses.
Oh, yeah.
And I don't know if you can dive in a little bit deeper, but it's something that, oh, you have a loss, but that's not always the case. Maybe you could just dive in a little bit deeper with how to profit off real estate from a loss.
I'll say it this way, because there are certain things that I will not talk about in public. Strategy, proprietary stuff. So I'll tell you it this way and how I was taught in some of my experience. I was fortunate in my career to work for, and then step up to partner and work with some of the most brilliant minds in mortgage banking. And one of the things, and he's long since passed, my past partner, Mike. But one of the things that he taught me was, or he didn't teach it to me, he kind of opened the doors for me and showed me about that world, was how companies would go in to look inside of a bankruptcy court to find companies that had many zeros in their loss column, and that's why they're bankrupt, and would go in and buy these companies just for the loss and the negative balance sheets. Why would they do that? And he would explain to me. Let's say you bought a company that had $10 million in losses out of the bankruptcy. It's got no assets, got no anything else, and you go in and buy all of the shares of the company that carries a balance sheet loss. You buy it for nothing. But why would you do that, Mike? Well, if you had a company that started, because most companies start from day one at zero. It's worth zero. As you get more income and you grow and you grow, you grow. That's what most entrepreneurs are taught what to do. Grow your wealth, build your... But what happens is the more you grow, the more that the IRS wants to take a bite out of what you have, right? So what if you started your business with a value of negative 10 million? Oh, well, because then as you grow and 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 you make all this new wealth, all you're doing is reducing losses. You haven't made income. And so I found that, wow, losses turn out to be, well, if I'm going to pay the IRS anyway, but some of these companies or some of these investors have found ways, well, if I can just redirect who I'm paying and how much I'm paying, I'm still paying. I'm not keeping it to my own wealth. I'm just paying it elsewhere. Well, that could be interesting. So I've used losses. I went into a couple of ventures with some of my partners, and we've lost money. Now, this is where one would say that I'm a terrible investor because I made it personal. And I don't care, because I do take my investments personally. Since it's my money and my investors' money, I do take it personally. It was a bad decision I did. I got excited about the deal. I lacked on my due diligence, and I and my investors, we all lost money. What I did was I made them whole by coming out of my own pocket and buying their losses, making them whole. One of my investors looked at me and said, "Why would you do that?" I'm okay with the losses. I said, "I know, but I don't want you, it's my reputation. I don't want you to invest with me and you lose on a bad decision." I felt bad. He goes, "You don't have to feel bad. We're all big people." I know, but, and I kept pushing. And then he looked at me and goes, "Why are you pushing?" I said, "Because I don't mind the losses." And he said to me, "Why don't you mind the losses?" I said, "The losses are a good thing." "Why?" I said, "Well, if we're making all this money here and I can accumulate some of these losses here, I can mitigate my taxable income legally. Can I buy some losses?" I said, "Would you like to?" And we bought losses. So losses are not a bad thing. They can become very valuable when coming to tax time, doing it legally.
And it's something that very few people ever think about, and the fact that you can buy it at a discount because it's already a loss.
Yes. But what I don't know, maybe you guys can find out, that was a long time ago. We can go and buy these businesses out of bankruptcy. I thought I heard somewhere years ago that they stopped doing that. I don't know if you're still allowed to buy.
No clue. We have to deal with bankruptcies.
Well, it's not just bankruptcy. It's like any business. Because I know there's business brokers out there, and they will broker broke businesses. But I don't know.
I can tell you, and this may be the answer to it, if you acquire more than 50% of the business, and it's partnership taxation, the capital accounts have to be reset, bringing the negatives back to zero.
But that's just if it's a partnership?
That's a partnership. I don't know how it affects in like a corporation, but so many of the syndications of the real estates we do are always partnership, and so that actually may be
that might
tweak.
Yeah,
that took away a lot of those benefits.
Do you know when that came into effect?
No clue.
I'm saying this will probably be in the last 15 years. I want to say
it may be.
Yeah.
I don't think it was the 86 Act.
No, I think it was 86. No. No, but maybe the 2010 area, right around the Great Recession, something that they probably just threw something in there. But I remember hearing something that they were taking that away about buying the loss. There's still other ways of doing it, but buying the business, that might be what you're...
I know that's, it takes it away if it's a partnership. I could see where there may be some possibilities from a C Corp, and this is just not legal advice.
Yeah, we're
just thinking.
Yep.
If it were a C Corp, you buy all the shares, and one of the ways to get around the double taxation of a C Corp is you just dissolve it. And then you get the assets, but I don't think you really get the negative.
Okay.
So that probably wouldn't work there either, because that's a way that we use blocker corporations if there's foreign investors into U.S. assets. If it's a partnership, which most of these real estate investments are partnership taxation, now there's a tax withholding from the foreign investors that goes to the IRS. The foreign investors have to file a tax return with the IRS. There's generally an offset with whatever jurisdiction or country they live in. But the easiest way to do these foreign investors is if they set up a C corporation. That C corporation becomes the investor. The income, the capital gains, everything goes back to the C corporation. C corporation still has to pay its taxes. But then when the time comes that the property sells, everything goes back to the C corp. The foreign investor just dissolves the C corp, takes everything back. And because the taxes have already been paid, because there's a dissolution, there is no longer a double taxation of the gains. It's just returning the funds and having a capital gain. So it's a great way around the partnership tax withholding. Hey, thanks for joining us today. I love that we got to really dive in deep with Rob, thinking about the, strategies for business for your team and how you can profit off real estate mortgages, whether they're working, not working, non-performing, or even how to make money out of bankruptcy. The ways to just expand the way that you're thinking and be able to invest as an active investor, passively the things to think about, and hopefully you got a lot out of it, and hopefully you will next time, and this is why.